Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy. And today I'm going to give you a conversation that I had with one of our Patreon supporters. And they really came back and they said they wanted to upgrade their retirement portfolio, but their chosen ETF that no one's talking about, which made them nervous. They feel that the fund is better than QQQI or GPIQ, but they said no one's talking about it. I haven't brought it much up on the channel. And they were concerned, why are they seeing something that, I am not personally seeing it? So I'm going to explain it all of what we've done and talked about. So before I do, I got to do a shout out to our Patreon supporters. Thank you for everything that you do. If you're not part of Patreon, I don't know why. You can go down below, hit that link. You can join for free. And if you want to help support the channel, it's available. If you want some one-on-one time, that's available. There's a lot of things available, people, on the Patreon side. So don't be afraid of that. And let's get into today's video. Hey, before we do, I got to do one big shout out. Remember, we do not take advertisers. We don't take sponsorships. We don't do any of that. What we do here is we support the channel by the coffee mugs and by the license plates. And by seeing it out there, the license plates, man, you guys really enjoy this stuff. Coffee cups have been flying off the shelf. The license plates are now taken off. Very inexpensive, $8.99, $6.99. Some very strong products. They make great gifts. We'll get them shipped right out to you. If you want, look at the QR code right there or go down in the description below. We're constantly adding things. We just added a king size mug. It's like over 15-ounce mug out there available now. So we get a lot of unique things trying to help you with the Retirement Made Easy Living on Dividends logo. So here's what happened. I got on a phone call and a Zoom call with one of my Patreon people, and they basically said that they want to switch out their monthly paying ETF with a weekly paying ETF. And I was always first off saying, hey, whoa, 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 whoa. Monthlies versus weeklies, that's a big stepping stone. That's a big thing to talk about. And they started explaining to me the fun that they had and that they're really saying, they've done their research, they've listened to what we said, they've looked at the total returns, better total returns, they've looked at income, better growth side of it, better income, just everything fit. They said there's just a better package across the board. And the bonus that they're getting is weekly paying ETF. So I started asking more, and I said, well, tell me which one it is, and we'll do a complete research. So why comparison really matter? Weekly income frequency is the ultimate retirement advantage. Everybody's starting to look at, man, this would be great because they're going to get a paycheck each and every week. So it makes things simpler for you, I'm going to call it. When you retire and your paycheck stops coming in, getting a paycheck from your dividends on a weekly basis sounds like an amazing idea. And you don't have to budget as much because I'm getting a check every week. So what we want to do, the convenience versus the strategy. Retirees are often attracted to weekly income, but frequency is a cash flow convenience, not a standalone investment advantage. So I want to make sure that you understand that just because you're getting weekly does not make it a better fund, does not make it, it's really just that convenience that you're going to have. You have to look at the income generation. How are they making the income? Is there a price growth? You got to look at total return, okay? You got to look at your expense ratios. You got to do your tax treatments. And you got to look at the fund maturity across the board, especially in retirement. So when we say someone's not talking about it, there's a reason out there why people aren't talking about it yet. Either the fund's very new or the maturity's not there, or the total returns don't look good, or the income generation is a new game out there, something different, and the yields are false. So I talked to them why this is so critical, and we broke each one of these down when we talked to them. So to tell you the first fund that they brought up to me was The Global X Nasdaq 100 Income Edge ETF. Now, this is the EDGO. This is a weekly paying, weekly income payments on the Nasdaq 100 exposure. It's a targeted income. It's a disciplined option strategy, and it's a risk managed focused. And I said, well, yeah, a lot of people aren't talking about this because the fund is only about 7 months old. It's fairly new account, and we're letting it get some breath, get some air underneath it. And they're saying they just think it was a much better fund. So here's what I started doing. I said, first off, let's do this. Standardize the comparison period. I do not want to compare QQQI or GPIQ because they've been out there for 2-3 years. They got track history underneath their belt. They got a lot of information on there that I can see that the product has gone through good times, bad times, and we can see how it reacts. Well, the fund that you're giving me, EDGQ, really is a fairly new fund. It came out in February 17th of 2026. This is when they introduced it. Now, this is nothing new to Global X. Global X had QYLD. Okay. So what this is an upgrade, and it fixes all the problems QYLD has. So it's a big change. So it's like buying the new version of Global X's Nasdaq 100, now called EDGQ versus QYLD. So the market, the identical market environment, I said all the funds measured against the same interest rate trends and the Nasdaq volatility. So we got to compare apples for apples, and that's what we told them we had to do. So our comparison window came in to be 146 total days of trading, February 17th to July 13th. Now this is going to include our yield, our growth, our total return, expenses for a 5-month window. Okay, this is all the information you have. So you want to make a switch from a 5-month-old unit from something that's been out there for a couple, 2, 3, 4 years. This is where right off the bat I'm like hesitant. I'm not jumping onto anything brand new. Even though Global X has been out there, I know EDGQ very well. I know the upgrades that it's done, and I do like these things, but this is the gamble they're starting to take. So I said, first, let's explain to you Global X, and let's explain EDGQ. Now, the core exposure, it invests primarily in QQQM, Invesco's Nasdaq 100 ETF. To maintain the high growth technology exposure. It's about 99% of their portfolios QQQM. Now what they've done is they overlaid an option strategy on this. This is an active managed strategy that sells call options to generate cash flow for weekly payouts. Now the weekly payouts is one of the big things that they were excited about, that they wanted that money each and every week. Now, we call this, it's a yield target. They are targeting, okay, a 13% annualized return. That's the yield they're looking at. So at 13%, I'm like, okay, it's an impressive number, but it's designed to produce the high level of current income while capturing a partial Nasdaq 100 upside. So again, we're looking for some income, but we're also getting some growth. Now, what they do is with this strategy that they use is called a dynamic portfolio coverage. And the managers adjust the percentage of the portfolio covered by option based on market conditions. In high volatility, they collect more premiums while covering less of the portfolio. In low volatility, they increase the coverage ratio to meet those distribution targets. Okay, so what is this system? And the simple one is what they did. QYLD did 100% coverage of the underlying assets of the Nasdaq 100. What they've done here is they adopted to the new system that like Goldman Sachs uses, is that they're using a portion of the portfolio is left open to grow or covered to create income, all in what's happening in the marketplace. Okay, so what they do is in that high volatility, they collect more premium while covering less of the portfolio. And in low volatility, they're increasing the covered ratio to meet the distribution targets. So I've told you before, the more you have of, I'll call it the bear market, okay, they're going to open up so they can get natural growth. And when they get onto the bear market, okay, they're going to bring it down so they can generate more income. I like the strategy. Don't worry. I really do appreciate it. And I do like the strategy. It's the new modern way that cover calls are moving forward with this. I expect to see a lot of companies switching to this system because it actually does generate some higher outputs. Now, the appeal of that weekly distribution. We talked about this next. I said, you're looking at EDGQ's weekly payout structure and retirement cash flow impact. You're getting about 7 cents per share per week, which as of July 13th worked out to be 13.31% annualized rate. Now, historically, when I looked back, I saw the thing was from 6 cents to 7 cents. So it's been fairly steady weekly income on this particular fund. But I did tell it right out, you got to understand, those numbers can change. They're not guaranteed. It's why everyone keeps using the target. We're just targeting the number. If we get close, great. If we go over it, fine. If we come short, hey, we were just trying to target. So the retirement income perspective is this: convenience factor. Weekly payments align better with that dynamic retirement spending needs than those monthly payouts. And I understand that. It's always easier getting that paycheck on Friday so you can pick up your bills here and there versus budgeting your monthly payout across 30 days. Now, the total yield rule. 4 small weekly checks must still be aggregated to compare fairly against one large monthly peer payment, which is basically saying is you can either take your monthly distribution and divide that by 4, or the simpler way I do it is take your weekly payout and times it by 4, and to get yourself what you're actually getting per month. So it just gives you an apple for apple, because I told them that's what we need to do is compare apples for apples. Now, the strategic goal, Global X targets a 13% rate by selling call options, providing income while retaining some of the Nasdaq 100 growth. One of the things that scare me with weeklies is how quickly can they recover. If you notice how these things work, when they pay out a distribution, they have to make that money back up. Now, most of this is done by the cover calls that they've done. And that's why I wanted to look at the historical range. How well are they doing? Is it actually the income money coming in and going out to you? Or are they using that ROC part of it that's going to take some money of the assets to keep the thing at that 6 or 7 cents per week and make it up in the long run? Now, distributions are currently estimated to include return of capital. I told them that right off bat, which we'll cover here in taxes, which defers your taxes. That's why weeklies are always critical to that point. And what happens when you use it, you get some NAV erosion. So you got to verify to make sure that your distributions are working properly. So let's take a look at all the numbers across the board and see why they were so excited about their move. One, income and yield. Now, we don't chase yield on this channel. But what we did here, remember, this is only about a 5-month period, February 17th to July 13th. The period paid in distributions, GPIQ was 4.7%, EDGQ was 5.6 and QQQI was 6%. Now, QQQI paid out $3.17 so far. Now, EDGQ only paid out $1.40. So you see how percentages are a little misleading? And GPIQ paid out $2.41. So same thing. Would you like to have 4% or 5%? I asked this question to her. I said, you can get your edge at 5.6 or GPIQ at 4.7. What would you prefer? She goes, well, I want the 5.6. Well, I'm getting an extra $1 from GPIQ in that same time period. I'm getting an extra $1 out of those shares. I said, that's why you got to look at not only the yield, you got to look at the cash payout, what's going on. So the key takeaway, QQQI generated the most immediate cash, while EDGQ finished second while providing a convenience weekly payments. But I also told her that GPIQ is actually paying equal dollars of $2.41. So we have to put that into the equation. But again, we don't chase yield only on this channel. We got to look at the bigger numbers. Now, this is where they really got excited about with me. They were like, whoa, 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 look at the growth side of it. GPIQ is generated 11.2%. Now, these all work off the Nasdaq 100. EDGQ was 10.6, and QQQI was 5.6. So when we looked at it, we said, whoa, your yield is 6%, and your growth on QQQI is 5.6 together. You're getting that equaled in the EDGQ. I buy and understand where they're coming from now, and hopefully I'm not confusing you. The growth alone on EDGQ is bigger than QQQI and QQQI's yield. Now, GPIQ is breaking even between the two. And I'm like, wow, you have learned from what we've done on the channel. So right now, EDGQ is definitely beating their QQQI package. Now, round 3, total returns. And this one was amazing. Both funds, EDGQ from Global X and Goldman Sachs, using the same exact strategy, using the very, very similar packages to the board. Both of them come in at 16.2% total return versus QQQI at 12%. So despite QQQI providing the highest cash income at that 6% or $3 a share, it lags in total return by 4.2 in the retirement. Chasing the highest yield can sometimes sacrifice overall performance of the growth. Though this is stuff, prime examples that I've been showing on the channel, that QQQI, definitely a great fund. I'm not putting any of these funds bad, but look at the difference that we have educated somebody there. They're seeing EDGQ is a better package than QQQI, equal with JPIQ as total returns come about. So this is where they pretty much told me this is why we want to drop out of QQQI and put all of our eggs into the EDGQ basket. Then the expense ratios came into play. Now I had to clarify them right off the bat. Now EDGQ waives their active fees until March 1 of 2027. Okay. After that, they're going to be about 0.53%. GPIQ, Goldman Sachs, is at 29 cents with a gross expense ratio about 0.35. And I'm telling you right now, I know I've got notice of this. GPIQ will be basically going up on their expenses up to about 0.35 anyways. And QQQI is the highest one at 0.68. Another big dig from them saying, look at lower covering costs than what we're looking to replace. We're doing a matching with GPIQ. We like the strategy. I love what they've been telling me all the way through with this. Tax treatments. Now, they are in a Roth IRA. Okay, so the tax treatments didn't really move them one way or the other. But I wanted to share with you guys, QQQI was ranked #1 for tax purposes across the board. They're using the Section 1256 with that NDX index, which is that 60% long-term, 40% short-term capital gains charging. They're using loss harvesting. Okay, tax harvesting is what I've always called it. And that is where they're selling funds that they may be losing on, sell it to help cover tax sides of it. Plus, they do use ROC. Don't let anyone fool you. The QQQI definitely uses that as well. So they use all three pieces. Now, JPIQ does use the ROC. But always remember, even though they're reporting this at 97.2%, you don't know what that is until you get your 1099 DIV form at the end of the year. So these are just estimates that they're coming across with. So what the ROC does, it reduces the base of the fund. So you're not paying taxes this year, you're paying it when you sell the product. And the NAV growth suggests it's a healthy ROC classification. So they're not doing anything different. So everyone knows GPIQ, I own it, is a very, very strong fund. Now, EDGQ, if you're putting this in a brokerage fund, it is new and unproven history. The track history has no complete calendar year to report from. They are saying they're still coming in at qualified income risks. The option strategy may be limited to that qualified income. We don't know exactly yet, but there are no 1256 sections, so I assume they will be using ROC into the package across the board. But since they were not in a tax brokerage account, we kind of said, okay, this is round 5, doesn't really much matter to them. But I wanted to do this for our viewers. Now, here are my concerns to them. The total assets under management. This is a part that they kind of missed. They missed the video on this one. Here's what I'm telling you. A fund that is under $50 million is something you need to worry about. You need to be definitely interested in, because they can liquidate. And Global X has done this, liquidated different funds. So this one only has $8 million. In 5 months, $8 million of total assets. Things are looking good, but not out of the danger zone. QQQI assets are $1.3 billion. Okay, so there's a significant size difference and a liquidity difference in the fund. So there's a big difference in stability. So if you're looking to get rid of QQQI, you're possibly taking yourself a huge risk because of the asset classification that's out there. It's a wider trending spread. It's a limited track record with only 5 months of history. And the operational stability, smaller funds face higher risk of merging or closure if the assets don't grow at the levels that they expect them to. Now, EDGQ is promising, I will tell you this, but the current size makes it a risky choice as a core retirement holding, comparing to the established peers of QQQI and GPIQ. So I wanted to make sure they understood this, that yes, I'm watching it. I've been watching it. It's slowly growing. That snowball is getting bigger and bigger. They're adding, almost, I'm going to put about $3 million a month into the fund. So this is a big positive feast, but I still believe, and this is why I've told them originally, I said, why we don't talk about this is because the fund is only 5 months old. In my investment portfolio, I do not invest anything that is, realistically under 6 months. I like to be at 1 year to be more in place with what people are doing. So as we went through all this with them, I said, look, here's the best fit for investor profiles. EDGQ is the cash flow optimizer. It's got strong weekly payments out there. It wants pure Nasdaq100 exposure with that QQQM. It's comfortable with small and newly launched ETFs, and the values participate, covered call growth. Everything seems to be a good underlying positive piece for the fund. So if you're really sitting here and you want that frequency, that you need that weekly payout, then of course EDGQ could be a strong long-term piece. But I look at QQQI as your income maximizer. It wins for income and that tax design. Now I know they were in a Roth fund, so the taxes didn't mean as much, but it prioritizes the highest possible current yield. It invested the premium in taxable brokerage accounts, and it's willing to sacrifice some upside for larger payouts. And I understood why she was looking to make the change from QQQI to the new EDGQ. Now, GPIQ is the one I just tell you is the most balanced retiree portfolio that you could put into it. It seeks an optimal balance of income and growth. It prefers established funds with larger assets based. It has the lowest expense ratio, and it wants a dynamic, data-driven option strategy. So I really told her, I said, look, I believe in the overall balance side of it. GPIQ is doing a very, very good job. EDGQ is following exactly what GPIQ is. You have two funds that are almost identical to each other. Total returns are about the same. You had the growth side virtually about the same, and you had the yield side of it actually leaned a little bit more GPIQ. So in the final rankings, I told them, I said, look, to me, I still think number one winner is GPIQ. I just think the balanced champion, the overall winner for retirees is definitely GPIQ because it delivers that strong 11% growth and that total return of 16.2. It's giving you that decent yield throughout that period. Now, QQQI was that income specialist giving you the biggest income across the board of those funds. And I know the taxes didn't mean much to you, but your total return is still very respectable at that 12%. But EDGQ is the promising newcomer. It's got a very impressive start, but we haven't seen it in troubling times. I'm using information from GPIQ of what they have done to say that it's been impressive. It's doing well and paying weekly. So if you really want that weekly payer, I would put this as a satellite piece first. I would not put it as a core. I would use number one or number two as my core products. And I would actually say, hey, look, I like putting both QQI and GPIQ together to work as a team. So I currently ranked it third due to the limited operating history. Okay, and once I see this thing get the base asset getting bigger, I always said it's 50 million was the magic number. If it gets closer to that by the end of the year, yes, I have no problem jumping into it. But this is really a wait and see still situation. I don't think it's a deal of unloading everything and loading up the truck. But you did do a great job of doing your research. So the final thoughts and the summary of all this, I still think QQQI is that income leader. That's what they're built for, is income. GPIQ is that growth. It's giving you that growth with some strong income. And I think, total return between the Global X and Goldman Sachs, both coming at 16.2, it just says, I think the strategy is right. The strategy works the best. So don't select a retirement ETF only by how often it pays or how large the yield appeals. You got to put it together in a bigger picture. And I told them, and they know about it, by our three bucket portfolio that we use for retirees. And I think you can go ahead and put a couple pieces of core together. You can put GPIQ and QQI together. You may put GPIQ and EDGQ together, except it's so new. And so we're just kind of like holding off, saying, I would just hold my horses a little bit. I think you got a fear of missing out, and you're trying to achieve so much in such a quick time. So what they chose to do, I talked to them afterwards. They came back and said, Doug, you were right. we're going to hold off until January when the thing has more time into it. We just thought it was something else. They did put some money into it. I will admit to you, they did put some money into EDGQ, just because they want to test the market. They had some extra cash, kind of some dividends that they got from QQQI. They said we're going to put some into it, start a small satellite package for it, and I was okay with that because they actually did all the research. We're not saying it's bad. It's just long-term retirement. The little bit they're doing, they can get out. Let me know what your thoughts are of all this. Let me know in the comments below. Do you guys think they did the right thing? Do you think I did the right thing? That giving them the EDGQ hold off, or do you think I should have told them jump all in? What would you guys have done with the information you have in front of you? Love to hear from you and see that, making sure I'm on the right path. And before we go, guys, I just got to say thank you for all the support. Thank you for everyone who's bought the coffee mugs and the license plates. You guys are phenomenal. Thank you for supporting the channel. And if you haven't, what are you waiting for? It's just a coffee mug. So hit that like button. Leave me a comment. Let me know what you guys think. Love to hear from you. And before we go, we got to tell you all this information is clearly just for educational purposes only. This is not financial advice or tax advice. I'm not a licensed financial advisor. I'm just giving you my opinion where I'm trying to help people out. The strategy fits. You got to have a strategy that fits your retirement goals best. Weekly income doesn't really always mean it's best. Maximum yield doesn't always mean it's best. Balanced growth is really what you're trying to find. You're trying to beat the inflation with income to live happily ever after, and we do it with living on dividends. Thanks, everyone. Let me know what your comments below.